concluding the paper on the program. Thanks to everyone for coming. I took a wrong turn, so I didn't realize I have to climb like 600 flights of stairs from the park. That's why I was like. It's a joint work with Marco Bellifemine, who is a second-year PhD student at LSE, and Tommaso Monacelli. So the motivation for this paper is very simple. So we want to build a HANK model for banks. That's the title. So we want to quantify the macro effects of heterogeneity in financial intermediaries in a parallel fashion, the way people have done for households, with people who worked on non-financial firms, now people working on space, like regions. I'm interested in financial intermediate heterogeneity, how to think about it, how to quantify it. Empirically, bank inequality is, very well known to be, very vast literature. Just, eyeballing the data, we see vast amount of heterogeneity in terms of size, risk taking, elasticities in terms with respect to aggregate demand shocks, say monetary policy shocks. There is another literature, empirical and theoretical, which studies imperfect computation of both the credit and deposit sides of the bank balance sheet. Right, they've done very old papers and recent new work. Financial stability, obviously, it's for a lot of central banks and quasi-monetary authorities. That's part of the mandate. So we want to study that in the context of HBANK. We want to have a framework on the world where there is a role for both exogenous and endogenous components of monetary policy. We want to have a non-trivial fiscal policy reaction that is not just, that is adapted to the case of intermediaries. And in a nutshell, we're studying the anatomy of monetary policy transmission with heterogeneous banks. So in this paper, we start with a very clearly defined canonical HBANK representative bank benchmark, against which we'll be comparing most of our counterfactuals. We introduce to that benchmark a mixture of fixed and transitory heterogeneity. So there will be types, and each type will be subject to uninsured idiosyncratic shocks. We also break scale invariance, since in the basic standard HBANK framework, whatever you choose it to be it Gerlach-Kiyotaki, Bronner-Myers-Sannikov, and so forth, the intermediary is scale invariant, meaning the size of the bank does not matter. We want size to matter. We will also break perfect competition on both sides of the balance sheet in order to bring it closer to the data and to study some important real-world scenarios, in particular the 2023 event, the banking crisis and the rise of deposit spread. So we want to have a realistic model. Financial stability is very tricky. So because we want to stay away from bank runs, because bank runs, psychological bank runs as an easy fix in a way, but we want to generate costly ex-post default risk that are driven by insolvency risk, but yet we want to have deposit insurance because we believe it's a salient feature of the environment. So it took me a long time, but we sort of have it in a very sort of compact way, and I will be defining things obviously more clearly. We will have occasionally binding constraints or capital requirements, and we will have reserve requirements. So banks will be required to hold reserves according to some predefined rule, and there will be interest paid on reserves. And the monetary policy the policy toolkit is twofold. So the monetary policy can control the policy rate and the interest rate on reserves. And there is a bank tax motivated by the G20 and the IMF and the Obama proposals following the great financial crisis. We will allow the government to tax banks in response to shocks. Very much similar in a way that you allow the labor income tax to adjust in HANK, for example. We will adapt the same idea, the endogenous fiscal response mechanism, for the case of intermediaries, and we will ask the question: does it make sense to tax banks in particular? And the answer will be, well, doesn't really matter. So to give you just a brief sketch of the map, because we have a very rich framework, a lot of things are a lot of things are happening, but we're going to reduce this very rich model to a set of sufficient statistics. So we introduce a notion of the marginal propensity to lend, which is clearly analogous and borrowed from the idea of the marginal propensity to consume and the marginal propensity to invest that people have used for the case of households and non-financial firms. This is a nice object because this is, to first order, this is actually inferable from the data by just, so for instance, running local projections. So we have a way of disciplining the model with the MPL object. And again, borrowing from a very successful way to quantify things from the HANK literature, we will be decomposing the general equilibrium transition path of bank lending to a monetary policy shock into direct and indirect effects. So this is the way to think about, so everything will be along the transition path, so in sequence space or in response to an MIT shock. And in general equilibrium of the bank lending channel, it consists of just two components: the direct effect, which is a function of the marginal propensity to lend object. So that's a partial equilibrium effect, if you will, and a whole array of general equilibrium channels. And in our case, there are four. So the first two is just the neoclassical return on capital. That's the profit and the capital gain. Then the real wage and the bank tax. And one of the questions we're after, which effect is more important, direct or indirect effect? Even in the basic HBANK framework, these questions have not been answered so far. So first and second, we want to see which, moving from HBANK to HBANK, which effects will dominate, and that will help us to understand what do we really need to nail down in terms of empirical consistency. And we want to understand, so that's some of the questions we're after. And so to give you a preview of the results, I find that 80% of the GE bank lending channel is due to direct effect. So this is in direct opposite of, for example, famous results in Kaplan-Mol Violante, which are, and that whole literature where indirect effects explain the vast, the large percentage of the monetary transmission. Why is this happening? Well, if you're in the literature, you're familiar with Ottanello-Wilbury econometrica, and our result is very similar to theirs. Financial intermediaries don't have the consumption smoothing model that households have. Thus, they're more sensitive to short-term rate shocks, and thus the direct effects are so important for them. Interestingly, once you move from HBANK to HBANK, the monetary transmission mechanism gets weaker. And that is not obvious. That is in a way depending on collaboration and which country you're working, because moving from HBANK to HBANK, what you're doing is you're simultaneously introducing a mass of very large intermediaries with a small MPC, small MPL, and also a number of banks which are small and have a large MPC. So whether the weighted average of those coincides or is bigger or smaller than the MPL of the representative bank, it's not obvious. So in our setting calibrated to the US economy, we find that monetary policy is weaker in HBANK. And there are so once sort of you accept it as a general statement, a lot of applications sort of arise from this immediately. For example, the rise of banking concentration. What is the impact of the rise of banking concentration on the impact of transitory monetary policy shock effectiveness? It has a dampening effect, because concentration is all about the lengthening of the right tail of the bank size distribution, the rise of the super banks, the superstar banks, which are large in size, low in NPL, that skews the aggregate NPL downwards. And so monetary policy gets weaker. So a whole lot of applications can be studied from this sort of general statement. But today, what I want to focus on, due to time limitation, also because the paper is it is quite long. I want to look at the 2023 regional banking crisis which results from the monetary response to a cost push shock. So this is literally the scenario in the model. We will reverse engineer a cost push shock that is big enough to generate an inflation that we have seen in the data. That's the idea. The monetary policy due to the endogenous component of the Taylor response, and then banks get hammered. Banks get hammered, and what we want to generate is a rise of financial instability. Default rate going up, despite deposit insurance, that is not easy to do. So we have to go through a lot of loopholes so to make this happen. And we don't have runs, because I don't believe that what we witnessed with the SVB and so forth in March and April of this year, they are not really runs. This is just interest rate exposure and monetary policy tightening that's a natural occurrence in microfinance. And I will be showing you that why should you embrace HBANK and not sort of your favorite representative banking framework is because financial instability rising in response to monetary tightening is only possible in the HBANK framework, because you need size heterogeneity. The representative intermediary will have to live for 1 million years, literally, to get a negative shock large enough to draw him to the default region. Because the representative intermediary in the HBANK framework never is close to insolvency. You need like 1 million year event. But when you allow for size heterogeneity and following a contraction of the shock, the distribution moves to the left. Now there is a significant non-trivial mass of banks which are close to zero in terms of net worth. Their default risk increases, and because default is costly, the economy suffers second level general equilibrium, suffering through the resources lost to financial instability. And also in this exercise, we will see that because of deposit market competition, or because of imperfect deposit market competition, following a monetary contraction, the deposit spreads will widen, just like we have seen in the data. Well, in the past few months. Okay, so very quickly on the literature, unless there are questions, please. So we're trying to introduce heterogeneity into the macro banking literature in a transparent way. We're borrowing a lot of the analytical and quantitative insights from the HANK literature, and we're embracing fully, well, not fully, but almost fully, the sequence space, not the sequence space 2.0 that Auclair advertised at the SED. That one is just insane. But so we're we're just basic shooting algorithms. MIT shops do fine for us. Okay, so there are several moving pieces. So we're starting from the capital producers, which produce the risky capital stock, but the units of capital are differentiated. So these are non-financial firms, and they have a preferred intermediary because they like different colors on the credit cards. So that's the motivation. They have preferences for different intermediaries. There is a Kimball aggregation of these differentiated units of capital. And once you impose Kimball, you can derive standard demand equations and using the Kriwoluzky-Willis specification, which is very well known. So we have sort of standard formulas for downward sloping demand curves, king demand curves, and so on. So the return on capital it will be homogeneous, and every bank will be earning it. Plus, there will be some heterogeneous perturbations, which you will see on the next slides. Households are non-standard. So there is GHH when it comes to consumption and labor. So there's endogenous labor supply. There's a consumption choice, but there are also deposits in utility, just like there's, this sort of the basic Cebrawski money in the utility function. So here, the idea is that you open your bank account, you see the bank account, and you're happy. That's basically it. So deposit goods are also differentiated. So not only are you happy to have money on your bank account, you also have preferences for different colors of logos, and that these two things will be internalized by the intermediary, and every intermediary will be charging a markdown on the risk-free rate in a heterogeneous way because banks are heterogeneous. So the budget concern is otherwise pretty standard. So there are some lump sum taxes, the net dividends that households receive from the banks which die every period, And there are riskless funds, mutual funds. So that gives us that's like a benchmark against which deposits are more preferable. So deposits are also riskless because of deposit insurance, but they're colorful. That's why households prefer them versus riskless bonds. So the return profile of the banks is the following. So everyone gets the aggregate return on capital multiplied by two elements. So your type, you can think of some banks being skilled and non-skilled, and this is you're born with it and you die with it. This is your permanent type, and that's Pareto, and that helps me get a realistic skewed size distribution. So each type will then have a transitory shock around the type, and that could be R1 normal, it could be skewed, it could be left skewed, so it doesn't matter. For today, it's going to be just a standard normal. Not standard normal, it's going to be the usual normal with some variance calibrated to the data. So the balance sheet of intermediaries is pretty standard, except that now we will be allowing in a general form for reserve holdings, subject to a reserve requirement, which always binds. So that's without loss of generality, that substantially makes my life easier when I solve it numerically. So the law of motion of the bank is a formidable object, but it nests the standard model very neatly. So you have so you have the tax component, and that's the bank tax, which is endogenous. It's endogenous to the idea that the government balance sheet constraint needs to be always in balance. So it will be adjusting along the transition path. Banks get the return on their investment to non-financial firms. They hold reserves. They pay back the depositors, what they're owed, subject to the retail deposit rate, which is determined in equilibrium, and it's heterogeneous. And there are some non-interest expenses which allow me to break scale invariance. They're convex, so side matters. So there is occasionally binding capital constraint, usual moral hazard motivations, or maybe if you don't like those, you can just say, there is a legal part, that's part of the legal environment. So there is insolvency risk, but because of deposit insurance, households ex ante think that banks will never default. So the default risk spread is not part of the competitive pricing of the deposit in the deposit market. But because of uninsured idiosyncratic shocks that banks face, ex post, banks can default. Well, they can get insolvent because they draw negative shocks. So there could be ex post bank failure, but ex ante there is deposit insurance. So that's sort of neat, because not pricing in the deposit risk spreads is quantitatively very useful. Otherwise, it's pretty ugly. So the new Keynesian block is pretty standard. So I get Rothenberg adjustment costs, the standard forward-looking Phillips curve. On the policy side, there is the Taylor rule, the link between the nominal interest rate path and the risk-free rate is through the deterministic Euler equation. So again, everything is along the transition. So that allows me to make this statement. The fiscal and financial policy follows the balanced budget rule. So the government can spend on big G. There are some lump sum taxes less transfers, but it collects income not from households, because they are Ricardian in our model, and thus they're quite boring, but from non-Ricardian intermediaries with a tax rate tau t, which will respond to when things happen. The risk constraint is based on, well, there is the default cost, which when financial stability is bad, default costs rise, and that will give us an additional guarantee. So I will skip the derivation. So in equilibrium, I need to price two objects essentially. Equilibrium is defined basically by prices. So it is a vector of prices. So for us, the deposit rate and the credit rate, which are time varying and bank specific. So in the deposit market, that the retail deposit rate is marked down times the promised rate, which under the deposit insurance scheme is essentially the risk-free rate. So the real rate that the central bank essentially chooses over time, is this rate. Then because of deposit in utility assumption and product differentiation, I get marked down heterogeneity, it gets aggregated up. I get an aggregate markdown times the promised rate, so the retail rate will be lower. On the credit side, I have a markup, which is subject to Gernot Mueller specifications. They're pretty nasty formulas, but they're in close form and well defined. Times the marginal cost. So the marginal cost depends on the interest expenses. That's the little RB here, subject to the reserve requirement, non-interest expenses, the shadow cost of the occasionally binding capital requirement, and the Mellis shifter. So like this is like the productivity shifter so that's the margin. So I can show very easily how to nest the special case, the HBANK, the representative bank framework is pretty much can be shown to be nested exactly as a special case. So I will show you just one or two. So an important object in the model will be the marginal propensity to lend. So here I'm showing you the distribution of banks that arises in equilibrium, and the MPL object is just the slope of the lending curve. It's declining in size. That's very analogous to the MPC idea, essentially. So I'm going to skip this for the sake of time, but basically we do a lot of work with local projections, and we match the fact in the model and in the data that smaller and less profitable banks are more responsive to monetary policy tightenings. So we construct these elasticities that are size and profitability dependent in response to monetary shocks, and we use these empirical estimates to sort of discipline the model. So a lot of things are happening in the background for quantification, but let me show you some applications. So this is how monetary policy behaves, monetary policy transmission behaves in HBANK. So just the standard Taylor rule, shock, positive Taylor rule shock, inflation falling, real interest rate rising, all the quantities fall, output bank asset deposit net worth, credit rate and deposit rate go up, real wage falls. So important, the deposit markdown falls, meaning the deposit spread widens. That's an empirical regularity. Default costs in here, the light blue lines increase. So following monetary contractions, financial stability worsens. That's essentially a trade-off. You know, the monetary stability, financial stability trade-off. And the bank tax rate here as well. So we have a non-trivial fiscal policy response. So okay, that's very nice. These are just impulse responses. So I want to decompose the output response path into direct and indirect effects. And I find that as you show in the preview, as you have seen in the preview of the result, the direct effects account for about 80% of the total output response. And in the indirect response array, that I mean, this you see that the rental rate is actually amplifying things because quantities go down, so return on capital excess returns go up. So the bank tax, even though it goes up quantitatively, it doesn't matter that much. And you just see how, but the direct effect dwarfs essentially all the indirect effects. So to put numbers on this equation that you've seen before, we find that direct effects are very strong, about 80%. Why? Because banks are more sensitive than households, and they don't have any consumption smoothing model. So this idea is again, Ottonello Winbury, non-financial front, we rediscovered the same sort of idea. So monetary policy is dampened in HBANK relative to RBANK. Why? I'm skipping over this thing because of time, because I want to show you the inflation experiment. Indirect, if you compare the behavior of HBANK versus to RBANK, heterogeneity on the left, representative bank on the right, indirect effects are virtually the same, but we find that direct effect are very much stronger in our bank than in here. You see the effect is about 1.7. In HBANK it's about 0.8. So what does it mean? It means that understanding marginal propensity to lend behavior is crucial. So that's again the opposite result from the HANK literature. In the HANK universe, understanding indirect effects is important, and that's why you have this array of papers that are adding additional indirect effects, the additional multipliers. For us, the multiplier is not as important. We really need to understand the distribution of NPLs. So finally, my final experiment, and then I will conclude. So here I'm simulating what we have seen in a way in the past 6 months. A cost push shock that generates a realistic rise in inflation. Collapse of quantities, rise of deposit spread. So here the dashed line, the deposit markdown falls. It's closer to zero. So the spread between the retail rate and the risk-free rate widened, as we sort of have seen, and people have been complaining about it. Why there is no pass-through to retail deposit rates? The default cost to the GDP ratio goes up, financial instability. So overall, the reality of quantities, price, and markdowns smashed pretty well. And sort of one of the final results in the paper is that if you do the same experiment in the RBank counterfactual, you don't get any financial stability. So if you want to have a realistic model where following monetary contractions that are responding to cost push shocks, if you want to get realistic financial instability, you need to embrace the heterogeneity paradigm, or forget about heterogeneity, continue working with RBank, and then introduce bank runs. But the theory of bank runs that we have are mostly based on stance cost. So that we could do. Yeah, that's a very cool graph. So that just like shows the realizations of bank failures. So we need to have bank failures in our bank models. In conclusion, what we're currently working on is to have sort of an interest rate corridor. That proved to be quite tricky, but we're working on it, and we're embracing McCann. Well, I'm going all in with optimal policy rules, and we're gonna, because we have this monetary financial stability trade-off, we want to ask what is the optimal coefficient in the Taylor rule. That's what we want to ask, and it's part of our broader agenda.
Thanks so much. We have a couple of minutes for questions.
In a study, right, you have persistence in the return for the bank, but not in the lending. So there's no maturity transformation.
No.
That's still you think the SVB application.
That's a first order question. You're completely right. So we could introduce it. So the problem will be like this, like the maturity, the spread. We would have to, how to endogenize it, that would be tricky. Yeah, as a first order, so that's a nice experiment, but it's not exactly the maturity transformation channel. You're completely right.
You said that without loss of generality, the reserve requirement is always binding. But how do you ensure that in the model? Doesn't that require an assumption about the market return on loans versus interest on reserve?
So in the previous version, I've worked with the assumption that it's occasionally binding. I get somewhat similar results, but quantitatively, then that's another Lagrange multiplier that's sort of annoying to keep track of. But if it's always binding, so in equilibrium, the return on the alternative is always greater. So and the margin banks always prefer. So I need mutual funds to sort of close the model, because for a very tricky reason, because there are these bank management costs, the non-convex adjustment costs, they move along the transition, and then they will be rebated back to households. But in order not to disturb consumption, households will not eat it, but they will put it into mutual funds. So that's trick. That's like the redistribution of monopoly profits that Kaplan has used in. So it's in the background to close loopholes.
Yeah, what if one question? So what triggers the runs in terms of aggregate shocks? Does it work with TFP shock? But you need risk shocks at the firm level as you need in the bank models.
So there are no risk shocks at the firm level. So there is.
So the aggregate bank risk shocks, what is triggering the clients?
Oh, yeah, very good. So monetary contraction shifts the distribution of banks to the left, the distribution of these financial firms. So more firms are close to zero in terms of net worth, and insolvency risk is a function of net worth. It's a probability of having zero net worth in the next period conditional of your current conditions. So if you're closer to zero, you're more likely to exit next period. Probability goes up, and then times the cost of default cost increases. So there is no runs, and that's why it's harder.
This is joint work with Rustam Jamilov, Alexander Kriwoluzky, and Fabian Seyrich. And the issue which we try to tackle here is related to this traditional perspective on the costs and benefits of monetary unions. Yeah, what's key here, we think, is that this traditional perspective is very much focused on the country, or in Mandela actually on the level of regions. Yeah? That's where optimum currency area started. So you discuss whether a country is better off or worse off by joining a monetary union. And the policy discussion is also framed in these terms. That's what we learned in the context of the euro. Last 25 years, we had lots of discussion of whether specific countries would be better off under given certain developments outside of the euro. There was, of course, the Brexit discussion, and later the Italexit discussions. Also in Germany, we had lots of discussion whether Germany at some point would be better off if it hadn't been on the euro. Yeah? So this is all at the country level, and this is understandable because we see there's a problem in terms of heterogeneity. If countries differ in terms of shocks, in terms of frictions, then there's the one size doesn't fit all issue. Monetary policy, you run one monetary policy, and it doesn't serve all the countries in the way it's best for them. Okay, that's all well understood and reasonable. Still, we think we can offer a change in perspective here by shifting the focus away from the country level to the household level. Yeah? And the motivating insight, if you want, is that the kind of heterogeneity which we observe at the household level really dwarfs the heterogeneity which you observe across different countries, in particular when it comes to income and wealth. Okay, and this heterogeneity within countries across the population is not necessarily well captured by a representative agent, because what's underlying here implicitly or explicitly, of course, is that you can aggregate within countries and you can assess the welfare of countries by resorting to a representative agent. Yeah? And that's, given what we have in terms of data, probably not always quite a good approximation. Yeah? So against this background, we do ask in this paper, how does operating a monetary union change the impact of business cycle shocks at the household level along the wealth distribution? We do that in what we call a HANK square model. So we basically take two HANKs and put them together. That's the idea. So the HA part, the heterogeneous agent, that gives us idiosyncratic income risk, incomplete financial market. That makes people safe in the face of income uncertainty, income risk, and build up wealth. Different wealth positions. And then there's the NK part, so simply good markets being characterized by nominal rigidities. That's our monetary non-neutrality, which makes monetary union make a difference in the first place. And then we have these two countries being interdependent on both on goods and asset markets. Okay, we think that this framework is nicely tailored to study the issue at hand for two reasons. First, because of this HA part, we have a meaningful, or we can generate an empirically realistic distribution of wealth and income in the two countries, which we call home and foreign. At the same time, the new Keynesian structure, so we really embed this in a standard new Keynesian two-country setup, and that gives us a reasonable business cycle fluctuation and also a business cycle co-movement across countries. Yeah? Now, what I should stress up front here is that we really take an ex-post perspective. So we currently can't do, to be honest, proper ex-ante welfare analysis. which would be the parallel to the traditional OCA literature, but we really take an ex post perspective. So we are looking at specific shocks and ask how do they play out in the monetary union for specific households, and would these households prefer to be outside of the monetary union given the shock we are looking at? So of course that depends a lot on the shock and the origin of the shock and the type of the shock. Still, what emerges from our analysis is a fairly general pattern, and I think that's the key message. We do this at two levels. The first part of the paper is a very super stylized version of the model where we can derive analytical results. And then only in the second part, we move to a medium scale HANK2 model, if you want, which we calibrate to the euro area and establish a few quantitative results. So we compare throughout how monetary union does in terms of shaping the business cycle model compared to monetary independence. And we do this at three levels of aggregation. First, that's the aggregate view. We aggregate not only across households, but also across countries. So we look at the union as a whole and the macroeconomic dynamics for the union as such. And here we find, and to us that was new and it's not in the literature, maybe it's obvious, I don't know, you tell me, we can kind of establish an irrelevance result of the monetary union, because we show that in this model, whether you run a monetary union or independent monetary policy, does not matter at all for macro dynamics. Okay, that's a nice starting point, we believe, to understand the second 2 points here, because then if we aggregate across countries, but within the brackets of the wealth distribution, so we look at the poor and the rich and the middle class in the entire union, we again find that monetary union does not make a difference in the sense that it does not change how specific shocks impact the wealth distribution, people along the wealth distribution. So if we lump together all the poor and all the rich, then we don't see a redistribution of the shock's impact from rich to poor or poor to rich. And then moving to the last level where we aggregate within the brackets of the wealth distribution within countries. So we compare the poor in one country to the poor in the other country. Then we observe that monetary union makes a big difference, and specifically it shifts the burden of adjustment horizontally from one country to the other country within the brackets of wealth distribution. This is potentially politically toxic, to be clear. So we are saying the poor in one country, they benefit being in a monetary union at the expense of the poor in the other country, and the rich differently. So this is politically toxic potentially, and then it's kind of reassuring because then in the second part we calibrate the model to the euro area, specifically to Germany and Italy, and then we look quantitatively where this horizontal burden shifting takes place and find the strongest effect in the tails of the wealth distribution. So we find that depending on the shock, some people may be better off or worse off, but really the difference where monetary union makes the largest difference is for the poor and for the rich. And for the middle class, there is hardly any difference. We think that may in fact rationalize why we still have the euro, right? Because as you remember, we have now 23, 25 years of euro, and we have constantly talking about exits and Brexits. Well, Brexit did happen, that wasn't the euro. So, but let's say breakup scenarios abounded, and so it didn't happen. And our rationale here is that luckily for the middle class in each instance, it didn't make such a big difference.
What kind of shocks do you actually mean?
So I mean, we are looking only at TFP shocks and government spending shocks in today's talks, but when I explain the mechanism, you will see that this is most likely generalizing to all sorts of shocks. So this is literature which I skipped. So this is the small scale version of the model where we derive this knife edge result. So this is only one type of asset. There's no price regime, the only sticky wages. And importantly, it's very essential here. And I got a lot of feed in earlier presentations because of that assumption. We make the country symmetric. So we have heterogeneity in both countries, but it's the same heterogeneity in both countries. So since people didn't like it in the quantitative version of the model, we relaxed that assumption. Okay, but the results we show now, they hinge crucially on that symmetry. Everything depends on the symmetry. And in the qualitative version of the model, you will see that approximately the results which we established for the symmetric model still hold in the asymmetric quantitative model. Okay, so this is what's also important is that we have these results, these closed form results only for a linearized perfect four-side solution around the stationary equilibrium. Okay, let me briefly show you the model because I'm kind of new to this HANK literature, and I was kind of amazed how, thanks to my co-author's efforts, we could basically write this down in a very simple way. Yeah? So that helped me, approaching the topic, I think. Yeah? So I want to convey this simplicity here. So this is the household problem, yeah, which is nonlinear because there's idiosyncratic income risk, which is this E term, so some idiosyncratic productivity. That's the key driver of these differences in the wealth, yeah? Because people face different income processes, and so they build up savings. Yeah? Otherwise, this is totally standard, the household problem. This is the open economy dimension. So that's the consumption basket. We bundle here domestically produced goods and imported goods. And here I should highlight the parameter n, that's the size of home, and 1 minus n is the size of foreign. So potentially these two countries differ in size. Yeah, there's home bias and the temporal elasticity, but that's not essential. Okay, so that's production and prices on the first side. So there's also, this is super simple. We have flexible prices but sticky wages. Production is linear in labor, and so in the end we have standard Phillips curves. Yeah, this is in producer price inflation terms, S is in terms of trade. It's an open economy, but there's really nothing fancy going on. We have an exchange rate here because we benchmark our monetary union scenario against a counterfactual, if you want, of independent monetary policies to see what kind of difference monetary union makes. And script E would be the nominal exchange rate. We have producer currency pricing if you want. Okay, so the simplest possible setup. That's fiscal policy. And you might expect fiscal policy to be at the center of discussion. It is not in this paper. So we have a companion paper where we really zoom in on fiscal policy. Today, I will be only talking about monetary policy. And here we are making some very important, but we believe innocent assumptions. So the assumption on monetary policy is here you have a Taylor rule at the union level when you run a monetary union. So IW would be the worldwide. I mean, we only have this union as the world interest rate, adjusting to the weighted average of producer price inflation, but that can be rewritten also in terms of CPI. So that's really like the ECB's inflation part, yeah? Harmonized index of consumer prices, just weighted with the country's sizes. You may have an output term, but that's not important. Yeah. What is important is that in our counterfactual scenario with monetary independence, we have exactly the same rule. So we're saying if there was two monetary policies and flexible exchange rate, these monetary authorities would run exactly the same Taylor rules. So with the same coefficients, the theta pi's and theta y's, except of course that now they look at the country inflation and country's output gap. Okay. Financial markets, we make life simple here in order to have all households to have the same portfolio in the sense of foreign and domestic bonds. So we have a mutual fund here who does the international trading of the riskless bond. So we get a UIP condition in the counterfactual where we have monetary independence.
Yeah. Do I understand correctly that the N, like the size of home bias, is symmetric between those two countries?
Yes. Yeah.
So everyone likes H good the same way.
H good. I think so. If there are two different countries, I like my home good in the same way as you like your home.
Your home good. Okay.
Okay. So we define a number of analytical results. We define these union-wide variables, and to get there, I want to make one point. Yeah, and I think that's maybe of general interest. Yeah. So what we do here is we aggregate consumption function within each country. And here we also use sequence-based representation. And so we say this is consumption in country home, linearized, in these relevant arguments for the consumption function. That's the counterpart in foreign, okay? And now the trick is, that we can aggregate these two consumption functions, which depend on country-specific variables, at the union level by exploiting the fact that these Jacobians here in the sequence-based representation are symmetric. And this is where our symmetry assumption kicks in. And so we get to this, this nice union-wide aggregate consumption function. So that's the highest level of aggregation, if you want. And then we rewrite this and we get to the dynamic IS equation. And so when we combine this in the same way with the aggregation of the Phillips curve, then we get to this guy. And this got me very excited about this project, that it was possible then to cast the whole thing at the union level into the canonical form, which I grew up with basically in the simplest rank model you can think of, Gani textbook style. So we have our canonical form here, and this holds even in this relatively say richer structure two-country HANK. Canonical form at the union level. Okay, and then we just need to specify monetary policy to pin down the equilibrium as usual. And that's what we are used to. And then we can establish the first analytical result by saying, okay, we have this canonical form, and now let's look at whether monetary union makes a difference. Okay, and the key idea is we compare the Taylor rule. Here, that's what we have on the monetary union. The interest rate, just here we drop the output term. It's not interesting here to keep things simple. So we have this response to the union-wide inflation rate, but compare this to what we get if we have independent monetary policies. Then we can just aggregate. Union-wide interest rate is given by the weighted average of these country-specific interest rates. They in turn are determined by these individual Taylor rules, and then we end up with the same thing. And that closes the model, and that shows in terms of aggregate dynamics, whatever kind of shocks you cook up, you still get that there's no difference due to monetary union at the aggregate level. Of course, the assumption hopefully I highlighted this sufficiently. We have the symmetry, and that allows us to aggregate this neatly up, and then we have the symmetry in terms of the policy. So in the end, monetary union makes no difference at the very aggregate level. So then monetary union is all about shifting the adjustment across households. Because overall the cake is the same. So that's the idea. We have no change in the cake. It's just how it's split. And so the question is it shifted from rich to poor, or is it shifted from home to forward? Okay. And what we show then is in this model, quite generally, that really it's not about vertical shifts. And the idea is, let's look at a generic household in home, household J. Then the idea is, since the model is symmetric, they may differ in size, but otherwise they're symmetric. This household J has n over 1 minus n twins. Let's call them J star. And then we have aggregate consumption. So there should be a W as the weighted average of these two guys. And these two guys may differ. But these individual consumption functions of the household in home and the household in foreign, they differ because they depend on the country-specific prices. But when we aggregate this, what matters is the union-wide prices, and they are the same as we have established in proposition 1. And so we can say that the aggregate, lumping together household J with its twin, then the aggregate response in that wealth bracket will be independent of whether there's monetary union or not. And so for each bracket, there's no difference. And that means that there is no shift from rich to poor or poor to rich, but it's all happening within the brackets of the wealth distribution from one country to the other.
Does everyone can borrow in the model? And is there like a risk sharing between, I don't know, the rich in one country and the rich, I don't know, I didn't fully understand.
No, I mean, this is all, I mean, you can borrow, I mean, this is operated through the mutual fund, but that doesn't change this. I mean, it all hinges on this basically linearized consumption function, which are symmetric. So I guess
Yeah, but like usually in this two-country model, you need to make either risk sharing assumption given the two country or.
Okay, what's the risk sharing? Okay, the risk sharing, yeah.
Addition.
Okay, so I see what you're saying. So well, there's at the household level, yeah, this idiosyncratic income risk can only be insured through savings, yeah, self-insurance, yeah, and having a second country doesn't change anything of this. So in that sense, having two countries doesn't give you additional risk sharing, except, you know, we didn't analyze that yet. You could think of the terms of trade, you know, giving implicit some risk sharing, as we know from standard rank models, yeah. Yeah, but not in terms of specific assets being traded. Yeah. Okay, let me turn to the quantitative analysis to see where this really matters. And here we use a larger version of the model following Christian and co-authors where they have this closed economy model. So we take these two countries. This is a fairly complex model, and I'm happy that I don't have to present it here because hopefully with my small model, we already set the stage. So we have two assets. There's an illiquid asset, housing, say, there's income taxes, there's capital production. So it's really a monster, to be honest. Yeah. There's also minimum income benefits in foreign and not in home. This is important to generate significant differences in the wealth distribution. I show you this in a second. Yeah. So in this model, we only have two types of shocks, TFP shocks and government spending shocks. We assume they follow AF1 processes. And in terms of calibration, we calibrate this to Italy and to Germany. Yeah. So Italy is home. I mean, we are for German quarters, but you know, we wanted to be open and pretend. So Italy is home. Yeah, we also Christians, American, and Italian. Okay, so that's something. Importantly, so we want these differences in the wealth distribution because people called for it. Yeah. In terms of macro parameters, to keep this fairly transparent, we assume the same macro parameters. Yeah. And I should also say we specify TFP shocks to capture the output volatility and the co-movement. Yeah. And this is just to highlight what I think is kind of nice of this model, that it gets here these micro moments, right, and the macro moments. Yeah. So this is the just to give you a glimpse of it in terms of the wealth distribution. What do we have here? Say this is the Gini, the wealth Gini in Italy and in Germany. So Germany is there's more wealth inequality, and we can by specifying the income process, we get these moments of the wealth distribution roughly right. We also get the macro moments right and the co-movement. Yeah, but I think
Yeah. You also capture the fact that there is much more home ownership in Italy compared to the foreign economy.
We do not target the home. I think so. The home ownership would be capital. I mean, that's the only thing we have, and so we have this calibration. I mean, there's no difference, but yeah, it could be more sophisticated or differentiated. Right? Okay, so this is the transmission of a TFP shock, which takes place in Germany. Germany is blue here, Italy is red. And here's monetary union, and here is independent monetary policy. Yeah, and this is like a super standard macro transmission, if you want. Yeah. So what's important to take away, nevertheless, is here. If you look at output, yeah, you see that monetary union makes a difference for how output in Germany and Italy responds to the shock. You know, even the sign can change. That's maybe not surprising, and it's fairly straightforward to rationalize that, because here that's the policy rate, a common monetary policy. That's the one size doesn't fit all problem. Here you have one policy response, and here you have the independent monetary policy benchmark where you have different responses. So the TFP shock is in Germany. So in Germany you would have, and that's important to keep in mind for later, you would have higher interest rates in Germany in response to that adverse TFP shock because it's inflationary. Yeah, say it's adverse supply shock. So monetary policy needs to raise interest rates. Yeah, and it doesn't raise interest rates that much if you operate inside a monetary union. Yeah, and say in Italy under independent monetary policy you wouldn't see interest rates moving at all. Yeah, so this is textbook. Yeah, one takeaway here is that the union-wide response, that's the black dotted stuff, is really the same. That's our proposition one. So macro dynamics at the union level do not change. Again, the cake's the same. Yeah, it's only how the cake is split across the countries. This is where monetary union makes it. Okay, same for government spending. Let me skip this in interest of time. So turning to proposition 2, here we see the consumption Gini. It differs in countries, but the union-wide consumption Gini responds again in the same way. You see, we have now these 2 heterogeneous countries, but our proposition 2 goes still through. There is really no monetary union doesn't shift the impact of the shock vertically. Okay, so now let's zoom into the horizontal shift, because this is what we are really interested in now. So to summarize what's going on, we look at the consumption equivalent variation. This is our exposed welfare measure. We just ask, how people like a particular shock and how they like the shock, given that they're in a monetary union compared to a counterfactual when they would be outside the monetary union. Okay, so the welfare impact differs a lot across shocks and origin of shocks. But what's robust is that monetary union makes a difference in terms of the tails of the wealth distribution. Okay, this is the main graph, I think, of the paper, because here you're looking at the consumption equivalent variation in home, and more specifically at the difference which you have because you're in monetary union relative to what you would have under monetary independence. And this is an adverse supply shock in foreign, and this is the consumption equivalent variation, or the difference in the consumption equivalent variation across monetary regimes along the wealth distribution in Italy, and this is in Germany, and it's a shock in Germany, originating in Germany, an adverse supply shock. To make this a bit more relevant, say we think of this as the current situation in Germany. Germany is dependent on Russian gas a lot, and we had this adverse supply shock in Germany. That's one way to think about it. And now you ask yourself, okay, how is this playing out in terms of the welfare effect, and what would Italians say? What are they? How do they feel about being in a monetary union compared to what they would experience outside the monetary union? And the idea is the poor, they don't like being in a monetary union in Italy. Why? Because interest rates are now higher, than what they would be otherwise be, precisely because you have that adverse supply shock in Germany. So the union-wide interest rate increases, even though it wouldn't increase in Italy if it wasn't part of the monetary union. So, and this increase in interest rates is what the poor Italians don't like. Because higher interest rate means everybody has to pay higher taxes. The government has to service its debt. And they are also indebted, so they face higher interest rates. They don't like this increase in interest rates. The rich Italians, they like it. Conversely, in Germany, and that's the mirror image you see here. That's our proposition 3, this horizontal burden shifting. So the Italians, they don't like it. The poor Italians don't like it, and the poor Germans, they like it. The poor Germans, they like being in a monetary union because interest rates in Germany are not increasing as much as they would increase if it wasn't for the monetary union. So that's good news for the poor German. It's bad news for the rich Germans. But important to take away here is that the middle class is fairly indifferent. For the middle class, not much of a difference. And you can play this. I mean, this is showing where this comes from. It's really the real interest rate driving this. I have no time to talk about it. You can also decompose this into taxes. But you can also look at other shocks, and the same picture emerges for all sorts of shocks because it's really this different interest rate dynamic. Okay, so I'm out of time. Okay. Yeah.
So you have a non-tradable good? No. But as soon as you depart in any way from the assumption of perfect tradability of goods or perfect labor mobility, this symmetry result will disappear. In practice, if you have imperfect mobile labor, if you have a non-tradable good, it distributes symmetrically across countries.
Yes, but okay, that's quite possible. I mean, we have the these results established for the simplest model, the symmetric model. In the quantitative version of the model, we relax the symmetry, and quantitatively we see it's for nothing. Now we could add additional features such as non-traded goods and see how it plays out. It could matter quantitatively. My hunch is from this, really, comparing these dotted lines. That's our first result. And here you see a little bit of breakdown of our exact proposition 3, because you see these bars here are not exactly the same. Yeah, this is due to the fact that we calibrate this to be an asymmetric model. If we calibrate it to perfectly symmetric as we did earlier, then this bar would exactly be the negative of that bar. So we can add all these frictions and see whether it makes a difference. My hunch is, given the mechanism which we outlined here, it will still be highly relevant also in a richer market with non-traded goods for mobile labor.
Ask the question.
Yeah, just to understand how you generate these difference in wealth inequality between countries. So you give one country minimum income,
Yeah,
and that's the country that will have high wealth inequality, right?
with the minimum income, exactly. Yeah, exactly.
Because they don't have a motive to stay.
Exactly.
anymore.
So thanks a lot, everyone. Thanks for coming to the session. So I'm going to present joint work with my colleagues Jiri and Oreste, with Gianluca Violante, and with Filippo Pallotti, who is a PhD student at UCL on the market next year. So do look at him; he's really good. And it's going to be a bit more empirical than the other papers, but I think the messages we talk about will be really connected. So the type of question we are interested in answering in this paper is does not need much motivation, which is like, who is mostly impacted by this recent rise in headline inflation. We're going to focus on the 2021-2022 period and in the euro area, and in particular in the euro area, the key drivers of this large rise in inflation were mostly energy prices, but also prices of food and other essential items. And there's been a big public debate on the topic, and one argument that's frequently brought, and this has been brought even to justify monetary tightenings, is to say, well, because poorer households spend a larger share of their budget in energy or in food, they're more hurt by inflation, and therefore monetary tightening is acting to protect them. But this argument ignores many other effects that this type of inflationary shocks have on households. I'm citing here two others. First, depending on the wealth distribution, wealthier households and older households tend to have more money in their bank accounts, and that's going to lose real value with inflation. Nominal wages adjust relatively sluggishly, so basically people that depend on labor market income will also lose purchasing power as a result of the shock, etc., etc. So what we want to do in this paper is first provide a simple but comprehensive framework to assess these different channels through which changes in inflation impact household welfare. And second, we will use a plurality of microdata from different euro area countries to give you numbers of these different channels, which one matters more or less to do a cross-country comparison, and so on. So I will be very brief on this in the interest of time, but there's more work on the topic, also by Claude, Gonzalo, and co-authors. She also cited the paper recently by John Grisby and co-authors, and many other empirical studies focusing on these heterogeneity consumption baskets. We want to be broader than that. So to give you a preview of our results so that you see where we're going to, we find that it's indeed the case that low consumption households face higher household-specific inflation rates, particularly in Italy, but it's going to be the case in all. We're going to sell the big four euro area countries. That's always going to be the case. The real wages of most households decline. Wages adjusted very little in the euro area in 2021, 2022, and that's going to have very big effect for most households for whom labor market income is most of their income. But because of this heterogeneity in net nominal position, so older households tend to hold more nominal assets and they're going to lose in real value, while many young households are going to benefit because they're holders of mortgages, but they also lose real value, so they need to pay back less debt in real terms. Overall, we find relatively large losses, so around 3/4 of all households lost as a result of the shock. And the average losses, we're talking about something like 10% of their income, so this is large. While we have like 1/4 of households, mostly borrowers, mostly young, who experienced gains, especially in high home ownership rate countries. Good. So let me briefly introduce the framework. It's going to be super simple. we want to measure this welfare change induced by this inflation shock. We have households that maximize utility subject to a budget constraint, and there are going to be just two periods. T equals 0 is going to mean the moment where the shock hits. We're going to equate that to the short run, and T equals 1 will be the long run where prices recover. I'll be more explicit about this in a second. Where real values recover. Households enjoy consumption, so they're maximizing the utility of consumption in period 0 and in period 1. We're going to give this utility function general. We don't take a stance on this necessarily. This could also vary across households. I'm not having here household sub-indices, but you could add them. And there's going to be a generic consumption aggregator that aggregates the utility from consumption across these different categories. Households receive labor market income net of nominal taxes and transfers. I'm writing here as a lump sum, but given that we're going to look at this household by household, this could depend on W and uncomplicated ways, and we're going to allow for that in the empirical application. And households can hold wealth in real assets, AKT, that's mostly housing and stocks, and in both short-term bonds and long-term bonds, which we're going to model as having a declining coupon, but that doesn't really matter, just a way of thinking about them. This will matter mostly because of mortgages, so we can equate mortgages to this type of long-term nominal assets. And additionally, we have one additional element here, which is that households we assume that households need to pay rental expenses, and then we will also take into account that this might be non-fixed nominally ex-ante. So the type of experiment we're going to do with this super simple framework is as follows. We assume that before T equals 0, all prices are consistent with 0 inflation. This is just a normalization. We can just normalize it to some 2% inflation, but nothing would change. At T equals 0, there is an unexpected one-off inflation shock, which is really a price level shock. So we assume that the price level jumps by this much unexpectedly and suddenly, and everyone expects this not to be so basically the price level jumps, stays higher thereafter, but there is no further inflation. All inflation is realized in the moment the shock hits. And at T equals 1, which we're going to equate with the long run, which is like after 2021, 2022, we will assume that, that's what I was saying, price stability is restored, but also that all real prices go back to normal. So basically, real wages recover, real asset prices recover. So we are basically back into the situation that we were before. Additionally, we also assume that whilst this shock can be different for different goods, so basically the price of energy can grow more than the price of, I don't know, clothing. In the long run, we're going to go back to the same relative prices that we had at the beginning. We can relax these assumptions, but that's what I'm going to show for now. Our object of interest is the impact of this inflation shock on V, on the value function welfare for each of these households. We're going to rely on an envelope theorem argument that's going to allow us to ignore changes in choice variables. So basically, we can just take directly the derivative of the Lagrangian of the problem I just showed and decompose it in its different components. The welfare measure we're going to show are so-called money metric welfare gains, which is very handy because we will be able to give it an interpretation in terms of money. We can tell you how many euros each household lost. And this is similar to, like, for instance, in a recent paper by Andreas Fager and Ben Moll and co-authors, where it has been going around for quite some time already. What we do at a more practical level is we take the derivative of the Lagrangian of this problem and we group all of the effects of this shock that feed into household welfare in two parts. One of them is and I'm going to show you these equations in the next slide. But the first one, which we call partial equilibrium, is going to be the direct effect of the inflation shock, in the sense that we assume that goods prices changes, so the price of energy, food, etc., all of the other things that households buy change, but all of the other nominal variables, so nominal wages, nominal asset prices, rents, etc., stay constant. So they're going to be devalued in real terms. That's in stage one. In stage 2, we're going to let them adjust. So we're going to say, okay, what happens if we take into account that the prices of all of these assets might also respond to the shock? It might partially undo some of this. And we will be able to also measure this empirically. So this is stage 1. Basically, it's going to be the change in inflation multiplied by your total amount of resources. And I'm going to show you, this is already connecting already what I'm going to show you in the empirical application. Different components of this stage 1. The first one is going to be what we call inflation differences. So here we're basically going to decompose this is the average inflation shock, and this is going to capture all of the heterogeneity in consumption baskets, the part that the poor consume more energy and so on. That's going to go in here, and that's going to imply that different households face different inflation rates. Then these other elements will be the labor market income of households, the net nominal position, so the amount of money that they have in bank accounts, bonds, minus mortgages, etc., that are going to lose real value as a result of the shock. Rents, which are also frequently, particularly in these European countries, they are nominally fixed ex ante, and frequently they are relatively long-term contracts. And additionally, there's also going to be a component coming from both dividends, so the returns of these real assets, and what we call capital gains, which is basically that because we are resorting to this envelope theorem argument, we assume that people that were planning on buying a house are buying a house anyway, people that were planning on selling are selling anyway, and they might benefit or lose because the real price of the asset they're buying or selling changes. That's going to go in there. Second stage is same story, but allowing all of these prices to potentially change. So we're going to have potential changes in wages, potential changes in taxes and transfers, also taking into account the endogenous responses of the government to the crisis, to the inflation crisis, of rents, nominal positions, and all of this. Yes.
Is this some tax bracket in the model?
We are going to allow for that. That's going to be in our, because we're going to measure exactly the net income of each household. So that's going to go, when I show you like the wages minus transfers, that's going to go in there. That said, the biggest effect we're going to find will come from this ad hoc government intervention. But yes.
This envelope condition, does it imply that you're not considering any portfolio rebalancing?
We're not, that's exactly
There's
right.
no excessive margin changes.
Exactly. But the way we think about this, that is, this was unexpected. So, I mean, of course, very financially sophisticated households could like very quickly like move money.
But you look at them like a shock, so I think.
Exactly. So the way we
think about longer, like maybe more persistent shock than.
Exactly. That's right. That's the argument here. Yes. Yes. Good. Okay. So let me now go in the second half of the presentation to the empirical results. So we're going to focus on the big 4 euro area countries, and I'm going to show you breakdowns of results by age groups, and within each group by quintile of consumption. This is a proxy for permanent income, just to, but basically the idea to show how it affected differently houses at different points of the distribution. As I said, we focus on 2021, 2022. We're going to consider both years lumped them together as t, our t equals 0. And we're going to use microdata from different surveys that relate to this euro area countries. Yes.
Just curious, can you show the categories of the consumption expenditure?
I can show the categories. And let me hope that the button works well.
Let's see.
So these are, they are like 16, 17, something like that. We're going to separate, I mean, we're going to make sure that we have stuff like electricity and gas explicitly there. And in terms of these categories, we're going to have the budget shares before the shock and before COVID as well, because we wanted to avoid the potential COVID effect, and then the prices of all of these from HICP.
Okay.
Oh, thank you. Thanks. Yeah. These inflation differences will come, this is what I just said. from the household budget shares and HACP data for all of the other elements. So to know what's the net income, what's the net nominal positions, what's how many houses they tend to buy in a given period, and so on. We rely on HFCS data, which is like the SCF for Europe, if you're familiar with that one. Let me show you first the household level inflation rates that we find. I'm showing you here the 4 euro area countries, young, middle age, and old, and within groups, these are different consumption quintiles. So what's striking about this graph, first of all, is like the large cross-country differences. And this is mostly driven by different interventions in energy markets. So while France and Spain directly intervene in energy markets to fix energy prices at wholesale level, and therefore it did not feed into HICP. Countries like Germany or Italy did a bit less so, and then compensated households through transfers and other types of exposed transfer, which means that this shows in HICP, but then there will be more transfers. We also see that in general, it seems to be a bit higher for the old, and there is the income gradient I was referring to. So higher consumption, households face relatively lower consumption. Good. So armed with this, we can compute this total effect, these effects for the two stages, stage 1 and stage 2 for the different countries. Let me begin with stage 1 and with Germany. We find, as I was saying, relatively large welfare losses in the order of like on average 10% of income, much larger for the retirees than they are for the young on average. And this is going to come through the relative effect of the different channels, which we can decompose. Beginning with the labor market income channel, we find that it's more or less, I mean, even though representing losses at time of a share of income, it's not a big surprise that this is relatively flat, but it's a sizable channel. It represents a loss of around like 5% of income due to the fact that nominal wages did not adjust here in stage 1. We are assuming that they don't at all. But this is relatively even across age groups. Instead, this different holdings of nominal assets or nominal debt is what's going to induce most of this age heterogeneity. So basically, it had an average a positive effect for the young, where there are many borrowers, in general negative for retirees, and this is also a very sizable effect. This is in the order of like, on average, say, like more than 5% of income. In comparison, this inflation heterogeneity due to different consumption baskets that many people talk about are relatively small. They're basically 1 order of magnitude less. It is true that in general it's better for the higher consumption households and a bit of a bigger loss for the lower consumption households. Rents in general, because rents are nominally fixed, and in Germany many households are renters. That's going to generate relatively small gains. Capital gains, because many young households are at the time where they're buying homes, and again, stage 1, we are assuming that nominal prices are fixed, so houses become cheaper here. That's going to be a bit of a benefit for the young, a bit of a loss for the old, because here we are also including like the rents that they get, so that they're losing a bit in those terms. Overall, between 5–15% of income, larger for retirees. Comparing across countries, I mean, I don't have time to go into all of the details, just to show you a couple of main points. In high homeownership rate countries like Spain, the effect of net nominal positions is larger, so the gradient is stronger. However, let me say something, I will repeat this at the end, but let me say it already. There's high heterogeneity here, so these are averages, but some households are borrowers and they're benefiting a lot. Some households are not homeowners, they don't have a mortgage, and all of this benefit is not accruing to them, so there's more heterogeneity, even more than this graph suggests.
So can I ask at this stage?
Yes.
For any nominal contract, somebody wins, somebody loses. Where do the other side show up?
If you're thinking of a general equilibrium, from a general equilibrium perspective, energy producing countries are winning. So in the sense that this shock on net for Europe was a loss, because Europe is a net importer of energy. So it makes sense that there are net losses even on the aggregate.
It's on the household, right?
Yes. But what I'm trying to,
The government really,
Financial
the government's really. No, but that should be, there's some current equivalence at some point. That must mean in my welfare function in the beginning, expected taxation, that's also. So it should cancel out. This is what I'm sort of missing. Where is this going? So suppose the government bond,
yes,
there's inflation.
yes. Then the government, no, I mean,
The government wins.
the government wins. Yeah, no,
Okay,
that's
that's
why.
taxes in the future.
Yes.
Where does it show up in this analysis?
That's not showing up in there. But as I'm saying, you need to take into account the external sector, because if we're really doing general equilibrium, there's also going to be a loss through that channel, which, I mean, here we don't have firms and we don't have the financial sector really taking all of that together into account.
I fully agree on the external part. There's a 5% welfare loss because of that. Anything else,
Yes, so here there are some who gain, like savers are losing, borrowers are gaining. On net, there is this net loss. We are not taking into account, I mean, you will see transfers in a second. So the government is going to undo some of this. So part of the gains of the government coming from the loss of value of government debt will be rebated to households through some of the measures that were implemented here. But we are not taking into account like potential long run effect because we don't know how they're going to be distributed. So we are agnostic on that. Basically.
it's important. No, I mean.
It is, but we can only do what we observe.
The bank's losing money because it has an over contract. Who owns the bank? Where are the shareholders of the bank represented here?
Yeah, so that, I mean, that is a very relevant question. I'm not disputing that, but it's very hard to basically unravel all of that ownership structure. Part of it is international, part of it is going to be the rich that own the stocks. It's tricky, but I agree.
But it's not there.
I agree. It's not here. It's just from the
No,
perspective of house. Yeah, definitely. Thanks. In terms, so just to show you here the four countries together. In the case of Italy, if you remember, like the inflation rates that we observed were larger. So there's also more heterogeneity across groups, and on average, the losses are bigger, at least in stage one. And in the last 5 minutes that I have, let me show you a bit about stage two. So we're going to take the best measures we have of changes in wages and transfers and all of these elements during these 2 years, 2021 and 2022. But the summary of our message is that these things, at least in the short run, did not change much. So nominal wages did not adjust very much. They are adjusting now in 2023, but they didn't in 2021 and 2022. Real asset prices, such as the price of housing and prices of stocks and whatever, did not grow in nominal terms. If anything, they dropped. And again, here we're just taking it as given from the perspective of households. So going back to your question. So basically, the second stage effects are going to be much smaller. They will undo part of the losses, but they will be small in comparison. That's our main lesson from stage two. And it's mostly all of these positive effects of stage two that undo partially stage one, but notice the different scale. This is 0 to 4%. It's going to come through transfers. That's basically these are tax rebates, checks to help you to pay for energy, all of that we are gathering all of them and then attributing it to the households according to the rules. These are a bit skewed towards the retirees, but again, smaller than the losses shown in stage two. Last thing I want to say empirically before I conclude is which I was hinting at the beginning, is that the fraction of winners, even though we are showing that, for instance, the young gain, it is not that all young gains. For instance, in Spain, it's around 50-60% of the young households. It's a bit less than 50% in Germany and Italy, because there is a lot of heterogeneity on what are the nominal positions of these households, to which extent did their wages adjust, if they did, during 2021, 2022, etc. So there's also going to be further heterogeneity. And let me conclude. So basically, we wanted to understand who bears the costs of inflation during these 2 years in this particular scenario. We find that it's mostly older households within each bracket, it's mostly low consumption households. We find larger losses for the case of Italy, more unequal effects of the different net nominal positions for the cases of France and Spain, with some households benefiting from it. We find that these direct effects through the loss of real value of wages and nominal assets are much bigger than the effects from price adjustments that we observe, because basically in the US, wages picked up a bit more quickly, particularly in the lower parts of the distribution. That was not the case in Europe. I didn't talk much about that, but just as a curiosity, we don't find frequently we say, well, we should buy real assets because they protect us against inflation. That's probably true in the long run, but here in the short run, and also partially because of the endogenous response of monetary policy and the like, it was not true. Like people who were holding housing stocks saw also real losses of housing values, real losses of stock values during this period. And that's something we observed. That's also why the stage 2 gains are not that big. It's very timely. And finally, we're also trying to understand a bit better to which extent there was some consumption substitution or substitution across asset classes. That matter. We also wanted to understand a bit better the speed of wage adjustment, because they still haven't fully adjusted. So we wanted to take a bit care of that. And also, I've been telling you, well, there's been government interventions directly in the energy markets, and there's been transfers. We are capturing the transfers. The government interventions are there in the price indexes, but we can compute counterfactuals, and we also wanted to compare those. And these are the things we are working on right now. Thanks so much. Yes.
So you've shown us that like how the way you measure is like the consumption heterogeneity across household does not seem to matter a lot in terms of welfare.
Yes.
This made me wonder, because you showed you had around 10 categories. If you have more categories, of course, this consumption heterogeneity becomes potentially bigger, right? And this could then, of course, matter more for inflation inequality. But I think, for example, like the work of Fabian Seyrich, like I think he uses CCX with hundreds of different categories, right? They see like substantial welfare costs.
Correct. So no, that's a very good point. So for this particular case, I think this is a bit less concerning, because the biggest increase are something like fuel, which we have directly, and it is a single category. We can start discussing about different subcategories of food and stuff like that, but like the big items whose price particularly increased during this period, we have it at, I would claim, a sufficiently narrow level of aggregation. We could go narrow. I mean, we don't have a data limitation. We could go. Okay. We could go narrower, because I think we have the data for that. Related to Jarabel's paper and also the one by Greg Kaplan and the other authors. They do find a lot of heterogeneity in inflation rates, but that was during the low inflation period, and they don't find it to be super persistent, and they find it to be very household specific, so not necessarily that correlated with your position in the income distribution and so on. So to the extent that that's not the case, then the how much that would increase our gradient would not be a large effect, but of course, both things are there in it. Thanks. Yes.
Yeah, you mentioned in your last slide the endogenous reaction of monetary policy, and I was thinking, if I understand right, theoretically, I understand you want to analyze the effect of inflation per se. I mean, assuming that monetary policy does nothing. So this is like one part of the question. But the other part is, I didn't really understand what you did empirically, because wages and other things were affected by monetary policy, unemployment, volatility. So
that's a point very well taken. In our empirical analysis, we can't separate that. For instance, in the paper by Grigsby and co-authors, they do some identified shock experiment with like the shocks and the typical like shocks to monetary policy decisions to understand these things. Here we wanted to take a broader perspective, in the sense of, I agree, it's a bit more like a case study. It's what happened in these 2 years. It's going to include the endogenous response of monetary for sure. But we wanted to we didn't want to be constrained to exactly the part of the monetary policy shock that we can identify and so on. We wanted to give you more or less like a welfare number,
But then you underestimate the costs of inflation because
Point-
the cost of inflation after the central
point
bank
well taken.
took care of it. It's not what it's
Point very well taken. Yes, yes.
problematic.
Agreed.
I was wondering if there are non-linearities in the effect, in a sense that if you have an increase in inflation of 2 percentage points or 3 percentage points, whether the composition would be the same or not.
So this is a very interesting point. In our empirical analysis, I think we cannot give an answer to that because some of these derivatives, when we look at how much the prices change and so on, we're going to look at what happened in 2021, 2022. So whether these derivatives are linear or not, we really cannot estimate it. But I think, and it's a bit connected to what I was mentioning about the heterogeneity rates of inflation and so on. Maybe the heterogeneity rates of inflation matters a lot when inflation is 1 or 2%. But when we have like inflation rates of like 8% and energy price increases of like 20-30%, then maybe they matter less comparatively and the other effects become bigger, definitely, but I cannot give you a direct answer. Good. So, thanks so much for your questions. Happy to discuss them here. We'll move to our last paper. Thank you.
Okay, well, thanks a lot for including our paper in the program and for sticking around. Just to work with Nita Beckman, Tel Aviv, Benny Bonn, Frankfurt, and David at Kellogg. And so, what we do is maybe not a big surprise for you here in the room, but we of course know that the Federal Reserve has changed its policy framework, and one of the motivations for doing so is outlined by Jay Powell and Jackson Hole in 2020. That maybe we're focusing on a broader employment mandate might have potentially specific benefits for peculiar groups in the labor market and could actually ultimately then in particular benefit low and moderate income communities. Now, I think it's fair to say that traditionally, normally monetary policy focus on broad labor market aggregates when defining what full employment means. But of course, as I'll show you also in our setting, that there's lots of heterogeneity in the average attachment of different subpopulations to the overall labor market. In particular, there has been some work that unconditionally is documented. That's unconditionally, I mean not in response to shocks. That populations that have lower average attachments to the labor market, they tend to benefit most when the labor market is tight. And so this broad-based and inclusive policy goal of the Federal Reserve therefore could potentially require that we need tight labor markets. It's as I just argued, this was one of the focuses of the policy review. And some people have argued, for example, this preemptive hike in 2015. Of course, potentially there might be inflationary pressure on the horizon, but actually bad for exactly those low attachment groups. And in fact, policies that would allow us to stay lower for longer might be beneficial, especially groups that are least attached on average, at least. And so we started working on this paper actually before the policy review in 2020. So I think at that time it was still fair and maybe still appropriate to say on average there's very little systematic, empirical, and to some extent also theoretical analysis of this mechanism. So ultimately what we try to understand in this paper is whether monetary policy benefits groups of the labor market that are on average the least attached, especially when the labor market is tight. And so the way we want to actually tackle that is first empirically and then theoretically. On the empirical side, we want to actually look at differential employment growth in local labor markets, where we separate the data by race, education, and sex. And the data structure such that we have quarterly data at the local labor markets. Think about 900 different local labor markets. within industry, and then we want to understand, like, whether different groups benefit more to an expansionary policy in tight vis-a-vis kind of slack labor markets, and then see whether this differential effect differs across these different subpopulations. The setting allows us that we can actually keep constant many things you might be concerned that could systematically differ across local labor markets over time and within industry. And so, like, key takeaway is that we see, for example, for Black Americans, for women, and for the least educated, that they benefit especially in tight relative to slack labor market, whereas actually there's no differential employment growth for like white, highly educated, and male employees in at least our sample and setting. And then, like, on the theory side, we actually kind of take a pretty off-the-shelf Keynesian model with certain matching frictions where we have heterogeneity in type of workers. We model that by just differential productivity. We don't want to take a strong stance that it's only productivity differences that differ across different subpopulations, but it's the easiest way for us to conceptually model that. Could also think that maybe perceived productivity on the side of the worker. And so, like, in the model I first show you that actually such a simple model actually shows you kind of mechanisms that are actually very similar to what we find empirically. And then once we actually have a model that, maybe we can take somewhat seriously, we do some counterfactuals, and we in fact show that, once you see in a setting where the Phillips curve is flatter, which we model by a higher degree of price stickiness, indeed, it's actually the lower type workers that benefit the most in tight vis-a-vis slack labor market. But also, for example, like, if you have like weaker inflation response, those types also benefit more. Of course, the opposite for stronger responses. Okay, so like, let me now directly tell you a little bit about the kind of data we are using. We use kind of local labor market data from the quarterly workforce indicator program of the Census Bureau with pretty much 20 years of data, quarterly data from the beginning of the 1990s till 2019. When I say local labor markets, I mean MSAs and micropolitan statistical areas, like, as I said, around 900 of those. And then we look at employment growth in those local labor markets for women versus men, kind of stratified by education, and Black versus white Americans. And then we do that within the 4-digit NAICS industry. And then when I talk about employment growth, I look at the quarter after the monetary policy shock happens over the subsequent 8 quarters. I also show you kind of quarter by quarter results and cumulative results, but the baseline is over the subsequent 2 years. And then, of course, like, one key ingredient of our analysis is kind of we need a measure of local labor market tightness. Now, of course, we have a very well-defined measure of tightness in the model. Unfortunately, like for the sample period we do not have vacancies at the local labor market level. So, like, what we do kind of as a proxy is like we use the prime age employment to population ratio at the local labor market level to measure tightness. In the aggregate, we actually show that, those two variables, like, the vacancy to unemployment ratio and this prime age employment to population ratio has a correlation of more than 90%. We are currently working on a more limited sample. More recently, we've actually also local vacancy data kind of backed that up, that even at the local level, there's correlation. At least at the state level, those measures actually line up pretty nice so far. Okay, then how do we measure monetary policy? Right now, actually, just baseline for today, I focus on like the average Fed funds rate within a quarter. We also actually like use high frequency identified shocks to instrument the Fed funds rate. I show you today like just the average Fed funds rate within a quarter. We have like time and local fixed effects. Like, can think of it like a deviation from like a Taylor rule. And I show you, as I said, like results for like the Fed funds rate. But actually in the paper, we show that in fact, actually, if you instrument, for example, the Fed funds rate with the high frequency identified shocks, if anything, results will be stronger. And so, like, as I mentioned, like, we want to look at different subpopulations that differ in the average labor market attachment, on average at least. So, like what you see here, this is now the employment to population ratio, which is substantially lower for Blacks relative to white Americans. It is increasing in education, especially in the buff, and then it also differs based on sex in our sample period. Okay, so then what is the empirical specification we are looking at? We now want to look at employment growth for a given group. So think about like Black versus white Americans within a given 4-digit NAICS industry, within the local labor market, those 895 local labor markets. But I mean T here, this means like in the quarter after the shock over the subsequent 8 quarters. And we want to understand like whether this employment growth, like, how it reacts to like, my employment to population ratio. It's just like to have the full specification there, but crucially here, this interaction term, the monetary policy shock interacted with my measure of local labor market tightness. And then we want to keep constant, as I said, kind of a rich set of fixed effects. So like we have like industry times location fixed effect that kind of allow us to suck up any variation due to unobserved kind of determinants of employment growth that are specific to a given industry and location. Could think about maybe, I don't know, the local supply of human capital, the transportation system, or the education system. But then also like fixed effect that actually are time varying at the industry level, could be any kind of unobserved time varying shock that is kind of common to industry, like, the demand for the output of a certain industry, something along those lines. We can keep that constant. And then we actually cluster standard errors here at the local labor market level. But as I said, like the key kind of animal we're interested in is this coefficient estimate on the interaction term. So we want to understand, is that differential employment growth for a given group, depending on whether the labor market is tight versus slack, as a function or in response to monetary policy. Okay, so let me show you a couple of results. So like here, we estimate the specification for Black Americans, we estimate it for white Americans. The point estimates you see, like if you look at the differential employment growth over the subsequent 8 quarters to an kind of a contractionary monetary policy shock in tight versus slack labor markets, you see that it's negative and statistically significant for blacks. What does it mean in terms of economics? If you now actually look at a 1 standard deviation kind of higher Fed funds rate, and you actually compare like, local labor markets that are very tight at the 90th percentile versus very slack at the 10th percentile, this implies a differential employment growth of about 0.9 percentage points, which is about like 10% of the average employment growth within our sample. So it's not negligible and it's actually quite sizable. And here, like this is the p-value of kind of comparing those two different point estimates. And you see like, well, of course, everyone benefits in terms of levels, in terms of looser monetary policy. But in our setting, that's not identified because of the fixed effect. You do see there's differential employment growth depending on local labor market tightness. For Black Americans, there's no differential employment growth for white Americans, and the difference is statistically significant. Okay, that's the first subsample we look at. Then we kind of just give you an idea, like, this is now just predicted employment growth depending on local labor market tightness, where the kind of the least tight local labor market is your middle category. And you just see here, like, if you look at deciles of local labor market tightness, there's quite some substantial differential employment growth across different localities in the US.
The computation on the wealth distribution or income percentiles are these conditional results, the ones that you showed.
So like,
for black and white, for example.
Yeah, no, so it's like,
that's
we estimated by type in the local labor market, keeping constant, like, industry times time fixed effect. So like, in the local labor market, if you say have like, I don't know, a certain industrial composition leading to a different income distribution by type, we would actually keep that constant with a fixed effect. But, there are potentially more sophisticated differential wealth distributions that these type of fixed effects might not capture.
So you're comparing poor blacks and poor whites.
No. So we compare kind of blacks in tight versus slack labor market, keeping constant like the local labor market structure and time varying over time. We do not do I think what you have in mind, like, we run those two as separate specifications here. You could also pool it, add an additional interaction term. I have kind of sometimes troubles doing triple interactions in my head, but then you could actually do a kind of additional fixed effects in there. Okay, so now here we just actually look at data stratified by education, less than high school, some college and bachelor and above. And so here you see, like, in terms of differential employment growth, again, like, negative Fed funds rate, meaning like expansionary policy leads to a stronger employment growth over the subsequent 8 quarters in tight versus like labor markets. For Americans that have less than high school degree, there's no differential employment growth across other kind of educational attainment categories. And in terms of like economic magnitudes, This now actually like if you do the same thought experiment, like 9 years versus 10, 1 standard deviation changed, about like 18% of the average employment growth in our sample over the subsequent 8 quarters. And again, like the differences for less than high school relative to bachelor's is highly statistically significant. The other 2 groups actually are not different. Okay, so the last one here we look at, this is now women versus male. Here you see like, at least in terms of like, the interaction terms and levels, it's not statistically significant for women, it's still negative. If you look at the difference between women and male, it is actually statistically significant. Like if you do like a reduced form or a 2-stage least square, the female coefficient becomes significant again. But here just showing that also like for women that are on average less attached in the labor market, they seem to also at least kind of directionally benefit more to a kind of more expansionary policy in tight versus slack labor market. So this is like what I wanted to show you first in terms of like point estimates over the subsequent 8 quarters. Now I briefly want to look at how these things actually kind of evolve temporally. So like what I showed you in terms of like point estimates, it's like this 8-quarter result here, like for example by race. Here if you do it like quarter by quarter, you see like the effect builds up to 8 quarters and then slowly comes back to 0 again. Here by education, it's also kind of after like 8 quarters, more like the biggest, and for like women also like up to 8 quarters, this effect builds up and then reverts back to 0. Those are the temporal dynamics. Of course, you could also like look at it in a more cumulative setting where you kind of accumulate up the quarter by quarter changes. That's what you see here. It's like, if you actually now aggregate up those quarter by quarter estimates, and you see actually like this effect is kind of actually pretty pronounced, builds up, and then at some point evens out after like kind of, I don't know, a year and a half or so. Okay, so like, key takeaways for us here is that, there seems to be evidence empirically that kind of groups that are on average the least attached to the labor markets that benefit the most when the local labor market is tight, at least using our proxy currently of the local labor markets. Now what I want to do is just briefly take a somewhat off the shelf kind of New Keynesian model with search and matching frictions where we have difference in types. So like we have 2 fixed types, we have high-skilled workers and we have low-skilled workers. Household preferences are standard in the sense that like, they supply labor inelastically, we have full participation, and we have full insurance against unemployment risk within each type. So similar like this maths assumption from the early 90s. And then we have like a separate intermediate and final goods producers just to kind of uncouple wage and price setting where we have fractions. Okay, so like intermediate good firms, then they like, they post vacancies which differ across the skill level, be it high skill and low skill. And then like vacancies are matched to unemployed workers according to a matching function. And here we allow for kind of a different matching efficiency that could potentially differ by type here. And this is just this psi here is like the matching elasticity, which however is then common across types again. And so like, each period we have that a fraction that is type specific, is exogenously separated from a job, and then employment by type is just evolving over time. It's the fraction of workers in the previous period that actually didn't get separated exogenously, plus the newly matched workers. Then we have like a mass of 1 of intermediate good firms that operate in competitive markets. They have flexible prices, have the same technology, and they produce kind of homogeneous good with like, capital and the 2 types of labor. With capital, then we have high type labor and we have low type labor. Here we actually can also play around with the different production function, core production function. Like for what we do here in our simple analysis, actually doesn't make a difference. And then firms actually, the intermediate good firms have to pay like a cost for posting vacancies, not vacancies, and wages are determined through Nash bargaining. Then we have final goods firms. It just effectively assembles the different intermediate good firms to a output, and then we have like a central bank that follows a Taylor rule. Now, what I want to do in this model is like, I want to understand whether now the impulse response of like high versus low types to a monetary policy shock differs across different kind of states of the labor market. And of course, to do so, I cannot actually solve it to first order. So like I need to solve it to second order, and then I want to actually now look at generalized impulse response functions to a 25 basis points expansionary monetary policy shock at different points in the state space. So like the baseline, I want to look at the ergodic mean where we have an average tightness, and then I choose a point in the state space where I have a 25% higher tightness for both types of the labor market, both high and the low type guys in the other state of the state space have now a 25% higher tightness. And then I actually now plot the differential impulse response functions across those two different states in the state space.
And the high tightness you achieve by looking at the different calibration.
Yeah, exactly. Yeah. We play around with parameters indeed.
It's a matching efficiency one, or? Because you could also think about elasticity of substitution between high scale and low scale.
Right now, we actually play around with the matching efficiency, but as you say, like many different combinations could get us there.
Yeah.
And this is still something we play around with.
Okay.
So like, yeah, this part is like work in progress. So like, we started out this paper where we had like a very simple one-type model, and then we looked at differences, and we looked at two persistent types, and now we actually are in a more business cycle type model, but so like this part is still kind of work in progress. Okay, so like, what I'm plotting here is now directly kind of the differential impulse response function in kind of higher tightness versus lesser or average tightness, in blue for low skilled, in red for high skilled, an expansionary 25 basis points monetary policy shock over time, percentage point deviations. And so like what you see here is like, if we look at low types, they kind of like benefit more in a high types labor market over time before it comes back to zero, relative to like the high skill type. They are pretty much economically in terms of magnitudes, barely any response, close to zero, first a bit positive, then negative, and then back to steady state. So like, here, the simple model. So effectively the way you can think about it, like, on average, of course, you have a higher fraction of high types already employed. And then at some point, the tighter the labor market goes, the deeper you have to go into the pool to still pull people back into employment. That's pretty much like, what Blanchard in the 90s is called the ranking effect. So very similar what's going on here in this model. And I guess depending on like how we choose this, the point in the state space determining the tightness, we can get additional mechanisms, but that's something we're still looking into right now. Okay, so this is the first thing. So now, given that at least kind of qualitatively, there seems to be something that's kind of akin to what we see empirically, let's play around a little bit with different kind of policy counterfactuals. And so the first thing we now do here, this is how we focus on low types. We want to compare like, what happens in the situation where you have a higher average price stickiness, meaning a flatter Phillips curve, meaning that potentially like, you can run the economy hotter without actually inducing now kind of inflationary pressure and needing you to kind of increase policy rates. It's like what you do see here, like this is now the differential. This is now kind of a double difference here. Yeah, maybe even a triple difference, depending how you think about it. Like this is now tight versus slack labor market generalized impulse response function in the baseline calibration for stickiness, in blue for low types. And this is the same difference in generalized impulse response functions for like now low types in kind of a calibration of the model where we have a higher degree of price stickiness. And what you see here is like a higher degree of price stickiness, a flatter Phillips curve leads even to a larger increase, a differential increase in employment for low types in tight labor markets relative to slack labor markets, compared to the same difference in kind of like the baseline calibration. So like indeed, potentially this idea, like, in a situation where maybe there's less feedback from kind of economic slack or pressure to inflation, running the economy hotter could be indeed especially beneficial for the low type relative to kind of the baseline calibration. And then the last thing we want to...
You don't look at inflation at all. I mean, I think even in this case, if the labor market is so tight, I mean, with that color, I would think you still see inflation shooting up.
So the inflation will react, but actually, given that the degree of stickiness so high, it actually is pretty smooth. So like, there's not an immediate kind of kickback via policy rule, but no, that's something we definitely need to report. It's just here, like, I come back to that in the conclusion. we are very far away from making any kind of welfare statements or anything. We just say, well, you know, there has been this discussion of maybe doing this type of, you know, more inclusive monetary policy. Do we find some empirical evidence and do some, you know, policy counterfactuals? But definitely, yeah, well taken. Okay, so the last thing I want to kind of in my remaining 1 minute or so briefly talk about is kind of discuss a little bit kind of differences in the policy reaction function. I guess ultimately what we want to do is compare like a standard Taylor rule to like average inflation targeting. Here, just, you know, a shortcut, you know, to see like whether the dovishness of the monetary policy stance matters for the differential employment growth. What we do here is like we go from our, yeah, exactly. We go from like, well, maybe I should actually have labeled that differently. We go from our baseline Taylor rule to a Taylor rule that just has a lower coefficient on inflation in the Taylor rule. And so like here, this is the, what we call here dovish Taylor rule in red. So like, you know, here you see like, if the central bank is now reacting less to inflationary pressures, indeed, you do see like low types employment growth in tight vis-a-vis slack labor markets is stronger relative to a more aggressive Taylor rule where the central bank puts a higher weight on inflation in the Taylor rule. And so like, you know, this is largely like an empirical exploration where we try to understand whether indeed there's differential benefits by type in the US labor market, depending on whether the local economy is slack or whether it's kind of hot. And we do find that groups in the US that actually on average have a lower attachment to the labor market, black women and the least educated, they seem to benefit more when the local labor market is tight. And so potentially like, you know, indeed this idea keeping rates lower for longer can benefit these specific groups. And then we, you know, take a pretty much off the shelf New Keynesian model where we had a heterogeneity type and we do some policy experiments, but this is still kind of work in progress. And like, you know, this is kind of for you, the last bullet point. Yeah, so like, you know, we cannot say anything about welfare optimal policy. Or we don't even attempt to. Thank you.
How far are the monetary policies symmetric? So now you look at tightening but loosening, and then if the quantitative response is pretty much symmetric, on average you don't gain anything. Or in that case, you could also think about asymmetric policy moves, right?
Not totally. So like empirically, like, you know, we played around a little bit with like a dummy web, whether it's positive or negative. Didn't come out significant, which of course also is like, you know, you cut the data already along many dimensions, and then you have 20 years of data quarterly. So like, and then you look at employment growth over subsequent 8 quarters. Like I wouldn't put too much kind of now into that specifically. But yeah, so like I'm with you that potentially this would be interesting to see also like whether it's also again like that the least attached are hurt the most to policy in tight versus slack markets. But yeah, no, right now I cannot make that statement.
Productivity differences is fine, I guess, as an approximation, but an easy alternative would be ex ante wealth differences. You could ex ante, you could have rich and poor, like, and then you could call the poor are black and or blue. So ex ante there is wealth heterogeneity. But another trick that some people use in labor is differences in the free labor supply elasticity.
Yeah. So that's something we indeed even in the model we can play or easily play around with. I'm not totally sure like how differences in wealth would actually kind of map into differences in labor force attachment.
No, it's not an alternative, not to high, not to that, but instead of high low skill,
yeah, totally.
You could have like high BC low BC because they're region point.
No, I'm totally with you, but so like,
point.
Yeah, no, I'm very sympathetic to that. But we start off from this motivation that we have heterogeneity in labor force attachment by groups, and once we however have some differences in NPCs, which you know, I'm with you. Like
maybe moving is costly, and if you're low wealth, you cannot move.
Okay, yeah, I have to think a bit about it, but yeah, thank you.
Regarding at least there is some evidence about these points of ours by income groups.
Exactly.
And policy shocks, and it's actually the other way around. So no income people then to increase hours worked local times for employment policy. So that I was wondering that so obviously you're looking at You know, and then they were on the side, there's. sometimes-
Yeah. For us, like, it's like,
Everybody, people can go on the down control.
yeah, I have to look into that. For us, it's like, are you employed, are you not employed empirically? So like, we don't look at an intensive margin, but it's like Filippo Peroni at the Chicago Fed. Okay.
Yeah, and external employee.
Okay, no, perfect, yeah. Okay, well, thank you.